activate your mic by pushing the button and activating the green light. We'll do one question and a quick follow-up to ensure everyone gets a chance, and then we'll see how much we have left for a second round. Libre à vous de poser vos questions dans la langue officielle de votre choix. So we'll start with Dave Fraser from the leader post.
Hi there. You said in your speech that implications of the trade environment were front and center. Given that there's still some volatility with the trade in Canada now, how realistic is a hike come October?
You know, what's happening on the trade front, whether it's the negotiations with NAFTA, the tariffs, clearly that's been a big factor for Governing Council in its deliberations for quite a while. In fact, we've been talking about how we've been taking on board what's happening with uncertainty, what's happened with what it means in terms of the actual tariffs, what they mean for the outlook, you know, over the past few months. And so the fact that it was front and center just reflects the situation where there still remains a lot of uncertainty with respect to how it's going to turn out. Now, I'm not going to preempt any discussion that we might have in October about what might happen with interest rates, because a lot of things can happen between now and then, not only on the trade front, but with many other things. And so we'll take all that on board and have our discussion and come back in October. I just say that when we were looking at the situation in July and throughout the year, we really did have to determine whether or not you know, the economy was in a place where it was a good time to raise interest rates. And clearly in July, given that the economy had been operating at potential for quite a while, and where we saw the inflation target, evolving with respect to our target, we felt that it was a good time, and that was clearly in a context of uncertainty with respect to NAFTA. Each decision's almost a blank page, and we'll have that discussion in October.
Follow-up. Greg from Bloomberg.
Greg Quinn, Bloomberg. Wondering if you could elaborate a little more on what you meant by a gradual approach to tightening. Was this mostly around the idea of moving faster because the economy was hot, or was there also talk of perhaps moving slower because of the economy's growing capacity potential?
So the idea of gradual really gets back to the idea of pacing and relates quite squarely with a risk management approach to monetary policy. You can imagine in the current context, with the economy running at potential for about the last year, and inflation where it is, that we would ask ourselves, well, what do we need to do to not get behind the curve? And so we looked really carefully at the data with respect to inflation and thought, well, and it looks like temporary factors, and I talked about those. They're related to gas. There's also minimum wage. And there are other things in there that almost mechanically are going to fall out. And so we don't see that that's reflecting some underlying excess demand that's building up. The other side of the risk management equation, if you will, is related to the fact that we could have more potential than we've built in. We saw already this year that when Statistics Canada revised their estimates for GDP and investment, there were some upward revisions that required us to increase our estimate of potential growth. And at the same time, we have to be conscious of the fact that highly indebted households that we see today are more sensitive to interest rate increases than they were in the past. And so balancing that going too fast and going too slow is something that we had in our minds, and in fact we have in our minds almost every time. The purpose of this speech is to talk about, you know, what we discussed and give you a flavor of how those discussions evolved.
I wondered, you know, it's been a while, especially looking back over the last decade, that we get inflation that's 3%. How is it that you have this confidence that so much of it is temporary and there won't be some kind of embedded shift in expectations or residual inflation hanging around?
You can imagine when inflation, we have a 1% to 3% target band for a reason. Inflation fluctuates, it has over history. And so when it's at close to the bottom of the band or as close to the top of the band, you can well imagine how closely we dig into the details, and we do that every single time. What we've seen over the history of headline inflation is just the fact that it bounces around a lot with gasoline prices. If you do the numbers, you can see that about 75% of the volatility in inflation actually comes from gas and gasoline prices, and that just falls out automatically as, over a year. And so if we were to react to that, we would be basically what I call oversteering. We'd be causing volatility in output, in employment, that we don't need to, because it'll just go away all on its own. On the other hand, it's possible that that could be embedded in inflation expectations, as you said. Again, when you measure those expectations, we do not see any evidence that inflation expectations are becoming unanchored. That means kind of drifting up. They're pretty firmly there. It's something that has happened in the past. If you look at the longer chart for inflation, total inflation, you'll see there have been years where it's been, popped up towards the top of the band, even gone above it, and also gone below it. Over the last 25 years, inflation, though, on average, tends to be pretty much bang on our target. I think the average, most recent one I heard is about 1.9%, and that's pretty darn close.
We'll go to Michael Joel Hansen from Reuters.
Yes, forgive me if this question is somewhat repetitive, but given the threat of auto tariffs and potential NAFTA exclusion, is it necessary to see progress in trade talks before the bank would consider hiking rates?
Well, as I said earlier, every time we do a decision, we look at where the NAFTA talks are, how businesses are feeling about that in terms of their business behavior, their investment behavior, and we look at what else is happening in the economy at the same time. And so I would just stress that NAFTA is probably the biggest risk to the outlook right now, but it's not the only thing that we're looking at. I'm pretty hopeful that the negotiations that are going on this week will bear some fruit, that there's reason to believe that some of the issues can be resolved. They haven't yet been resolved, so we'll have to see. One of the things that's pretty important to understand in how we think is that whether the trade agreement's resolved or whether it isn't, it's really the impact that the situation has on inflation. And in the case of more uncertainty and it's not resolved, the implications for inflation are two-sided. I said that in my speech, and it's related to the fact that it's not great news. Tariffs aren't great news for output, not great news for jobs. At the same time, unfortunately, depending on how it's implemented in the full range of actions that are taken, it can put upward pressure on inflation at the same time. How those two sides balance out is something that you need to look at the time based on the full situation. And so the monetary policy response that we would take in any hypothetical situation or any actual situation depends on that. And so what people need to keep in mind and be confident about is that our focus will be clearly on our mandate, which is to target inflation.
Did you have a follow-up? So we'll go to a second round. So, Greg?
That was great. You mentioned the 10-year anniversary of Lehman, the broader global crisis. Do you think the era of easy money is sort of near the end now? Or where does monetary policy head from here globally?
Well, it certainly depends on the outlook, but as we see countries continuing to expand, the U.S. is a prime example of this, where monetary policy is already normalizing, if you want to use that term. Europe has seen continued growth. At one point, it's going to be a natural thing to do for these countries to begin to put monetary policy stances back to what we would consider to be more normal. The timing of that really does depend on the decisions of those central banks and their comfort with making those moves. I can say that what we see in the global economy is continued growth. There are some downside risks we've seen in Europe, a little bit in China that are coming from the trade tensions, but nothing that derails an expansion. And so I don't have insight to their policy discussions. We're both going to be watching that. But certainly the fact that the global economy has seen some sustained and fairly synchronized growth over the past couple of years is a breath of fresh air from what we've been living through since the Lehman crisis and the financial crisis.
And did you have a follow-up?
There was talk for a while that, we learned the lesson we needed to learn in global financial markets when we de-risked, but, some people would look at, almost unprecedented stock market rally, the rise of Bitcoin, some things going on in the ETF market, signs that we perhaps haven't learned the lesson. How much smarter have we really become over the last 10 years?
Well, I'm hoping a whole lot smarter. A lot of good things have happened on the capital side, on the liquidity regulations side, leverage for financial institutions. And that stands us in good stead when we do stress tests for financial institutions. I think what you've touched on is what typically happens is that risk doesn't stay the same or in the same place, that's for sure. And so what we're seeing now are some opportunities to take advantage of either regulatory arbitrage or just explore with some financial innovations in a way that do create risk. Does Bitcoin or other crypto assets right now create risk to the financial system at large? I would say no. Are there consumer protection issues, investor protection issues that need to be taken care of? Absolutely. ETFs, again, it's about knowing what you're getting into and having the risks, including liquidity risks, being priced correctly. I think there's a couple of areas where more work needs to be done. It's not just a question of risk morphing, it's a question of taking care of some business that has not been addressed sufficiently, in my view, to date. One area is related to thinking about how macroprudential policies can really work with monetary policy when you've got low interest rates. You can use these tools, whether they're housing finance tools or other, to mitigate a buildup of risks in housing in particular, and household indebtedness. We need to learn a lot more about those policies, how they work. Another area is a lot less glamorous, and it has to do with operational risks. I think cyber and other operational risks, a big reliance on big tech, cloud computing, has opened up opportunities to propagate risk through the system in a way that we need to get a handle on and improve our risk mitigation mechanisms and recovery mechanisms. And Canada and the Banque du Canada is pretty devoted to that aspect as well.
Michael?
Yes. How much confidence do you have in the rotation towards business development and exports?
So our forecast shows that housing and consumption, kind of relatively speaking, will continue to contribute to growth, but by less than what we've seen over the past 2 years, and that exports and business investment will take more of a leading role, relatively speaking. And what we've done in our forecast is to be pretty I guess, modest in our expectations. With growth in foreign demand as strong as we expect it will be, it has been and we expect it will be, that of course is going to provide an opportunity for growth in exports. At the same time, we're conscious of the fact that Canada's been losing market share. There's a number of studies that we've published over the last week for anybody who's interested in that to dig into. And so we expect exports to grow, but by less than they would have if we didn't have these competitiveness issues. And it's the same with investment. When we talk to businesses, even though financing conditions are great, there's strong demand for the products, They can't export as much, maybe in some cases, as they could, because they don't have the capacity and they're not in a position to feel comfortable making that investment right now because of NAFTA. So we've also built that in. Even with a cautious outlook like we have, the combination of a little bit less contribution from housing and consumption and more from exports will give us that rotation. We've already been seeing it for the last year. We just expect it to continue. There's downside risk to any outlook, but there's also upside risk too.
So that's all the time we have. Thank you everyone for coming, and have a great day.